This is getting crazy. The silver spread just hit $13 in Shanghai as Shanghai touches $112. Hey guys, we need to talk about what's happening in the silver market right now. My name is Josh and this is the American Guy Finance. And I'm not exaggerating when I say this could be one of the most significant moments in precious metals history. On January 15th, 2026, something unprecedented happened. The Shanghai Gold Exchange closed physical silver at over $112 per ounce. Meanwhile, COMEX futures were trading around $91. That's a spread of over $13 per ounce between paper and physical markets. But here's where it gets absolutely wild. Shanghai prices actually touched $114 in some transactions. We're watching the biggest disconnect between paper silver and physical silver that modern markets have ever seen. And this isn't some temporary blip. This is a structural break that's been building for months. Today I'm going to break down exactly what's happening, why this spread exists, what it means for the global silver market, and most importantly, what happens next. Because trust me, the implications of this are massive. Whether you own silver, trade commodities, or just want to understand global markets, you need to know what's unfolding right now. Let's dive in. The paper versus physical disconnect. First, we need to understand what we're actually looking at here. When we talk about silver prices, we're really talking about two completely different markets. On one side, you have COMEX. That's the commodity exchange in New York. This is where silver futures contracts trade. These are paper contracts. Most of them never result in actual physical delivery. Traders buy and sell these contracts thousands of times. The same contracts change hands over and over without anyone ever seeing an actual silver bar. On the other side, you have the Shanghai Gold Exchange. This is a delivery market. When you buy silver in Shanghai, you're getting actual physical metal. Real bars. Real delivery. Metal that actually moves from one vault to another. For decades, these two markets traded at roughly the same price. Maybe $1 or $2 difference to account for shipping costs and premiums. That made sense. If silver is $65 in New York and $66 in Shanghai, that's just logistics. But now, we're seeing $8 to $13 premiums in Shanghai, and in some spot transactions, prices have blown past $100 per ounce. This isn't about shipping costs anymore. This is about something fundamentally broken in the pricing mechanism. Here's the crazy part. This spread represents a massive arbitrage opportunity. You should be able to buy silver on COMEX for $65, ship it to Shanghai for $1 or $2, and sell it for $78 to $104. That's a potential $20 to $30 profit per ounce. But that arbitrage isn't closing, and that tells us everything we need to know about the real supply situation. Backwardation and what it really means. Now let's talk about backwardation. This is a technical term, but it's crucial to understand what's happening. In normal markets, future prices are higher than spot prices. That's called contango. It makes sense because storing metal costs money. Holding inventory costs money, so prices further out in time should be slightly higher. Backwardation is the opposite. Spot prices, the price for immediate delivery, are higher than future prices. This means people are willing to pay more for silver right now than for silver 3 months from now. Shanghai silver entered backwardation on December 24th. Despite already trading at $7 to $8 premiums over COMEX, immediate delivery prices were still higher than future contracts. This is a massive red flag. Backwardation in a commodity market usually means one thing: acute shortage. People need the metal now. They need it so badly they'll pay a premium over future prices to get it today. And this isn't happening because of speculation. This is happening because of real industrial demand colliding with vanishing inventories. The inventory crisis. Let's look at the actual physical metal situation, because this is where the story gets really interesting. Since early September 2025, COMEX registered silver inventories have dropped by 1/3. Registered inventory is metal that's available for delivery against futures contracts. It's the actual physical silver backing those paper contracts. 1/3 of that inventory gone in less than 4 months. That's not normal market fluctuation, that's a run on the bank. Meanwhile, in China, silver stockpiles have fallen to multi-year lows. By November 2025, Chinese inventories were at their lowest levels in years, and demand keeps accelerating. China now accounts for over 50% of global silver consumption. Between industrial use and investment demand, China is vacuuming up available supply faster than the market can replenish it. The solar panel industry alone is consuming massive quantities of silver. Every photovoltaic cell needs silver for electrical conductivity. And China is the world's largest producer of solar panels. That industry is exploding, and it's eating through silver inventories at an unprecedented rate. Add to that electronics manufacturing, electric vehicles, 5G infrastructure, and investment demand, all competing for the same limited physical supply. Why the arbitrage won't close? So let's get back to that arbitrage question. If there's a $13 spread, why isn't everyone buying COMEX silver and shipping it to Shanghai? First, physical delivery on COMEX is actually difficult. Most contracts are cash settled. Getting actual bars delivered requires navigating a complex system, and there simply isn't enough registered inventory to satisfy major delivery demands. Second, shipping physical silver internationally isn't simple. We're talking about regulated precious metals crossing borders, security, insurance, customs, logistics. Bloomberg reported that traders are actually booking transatlantic cargo flights to move silver bars. They're going to extreme lengths to capture that $8 to $13 premium. But here's the real issue. Even with all that effort, the spread isn't closing. That means the demand in Shanghai is so strong and the available supply is so limited that even massive arbitrage efforts can't equalize prices. Think about what that means. Professional traders with millions of dollars and sophisticated logistics networks can't close a $13 arbitrage gap. That's not market inefficiency. That's a supply crisis. China's strategic position. Now we need to talk about China's strategic control over silver supply chains, because this adds another layer of complexity to an already explosive situation. China controls approximately 2/3 of global refined silver production, not just consumption, production. They're mining it, refining it, and processing it within their borders. This gives China enormous leverage over global silver pricing, and there are growing concerns about potential export restrictions. If China decides to limit silver exports in 2026 or 2027, it would choke off supply to the rest of the world. We've already seen China implement export controls on other critical materials: gallium, germanium, graphite, strategic materials for high-tech industries. Silver could easily be added to that list. If that happens, the rest of the world would be scrambling for available supply, and prices would have no ceiling, because industrial users can't just stop buying silver, solar manufacturers can't halt production, electronics companies can't pause their supply chains. They need the metal, and they'll pay whatever it takes to get it. Price discovery migration. Here's where this story gets really fascinating from a market structure perspective. We're witnessing a fundamental shift in how silver prices are discovered. For decades, COMEX has been the benchmark for global silver prices. Exchanges around the world referenced COMEX futures to set their own prices. It was the global standard. But if COMEX prices no longer reflect physical reality, can it still be the benchmark? If Shanghai is consistently trading $8 to $13 higher, where is the real price? We're seeing price discovery migrate from west to east, from paper markets to physical markets, from speculation to actual supply and demand fundamentals. Some analysts argue that COMEX has become irrelevant, that it's just a paper casino disconnected from physical reality. Others say COMEX still matters because of its liquidity and accessibility, but the market is voting with real money. And right now, the market is saying that Shanghai prices reflect true value better than COMEX prices. This has massive implications. If price discovery shifts to Shanghai permanently, Western exchanges and Western market participants lose influence over global pricing. China would effectively control silver price discovery through their physical market dominance. What happens next? So what are we watching for in the coming weeks and months? First, watch COMEX inventory levels. If registered silver continues dropping, pressure on paper markets intensifies. At some point, either prices must rise to reflect physical reality or the exchange faces a delivery crisis. Second, watch Shanghai premiums. If they stay elevated or widen further, that confirms the structural shortage. If they narrow significantly, that suggests supply is catching up with demand. Third, watch for policy announcements from China. Any hints about export restrictions or strategic reserve building would send shockwaves through global markets. Fourth, watch industrial demand data, solar production numbers, electronics manufacturing, electric vehicle production. This tells us whether demand will stay strong or potentially ease. What this means for you. Whether you're an investor, a trader, or just someone trying to understand the global economy, this matters. Silver isn't just a precious metal, it's a critical industrial commodity. It's in your phone, your computer, your car. It's essential for green energy transition. A structural shortage in silver has ripple effects across multiple industries. Higher costs for manufacturers, supply chain disruptions, inflationary pressure. These things affect everyone. If you're interested in precious metals markets, we're living through a historic moment. The kind of price disconnect we're seeing now hasn't happened in modern markets. How this resolves will shape commodity markets for years to come. Stay informed, watch these developments closely, and understand that what happens in silver markets doesn't stay in silver markets. It affects the broader economy in ways most people don't realize. The $13 spread isn't just a number, it's a signal, a warning, a sign that something fundamental has changed in global commodity markets. Thanks for watching. Hit that subscribe button and turn on notifications so you don't miss updates on this developing situation. I'll be tracking these markets closely and bringing you the latest analysis. See you in the next one.